Are you one of the many busy professionals working in offices day in and day out? Do you wonder how some people grow their wealth fast, retire early, and play on workdays? Well, you're in luck, because Ginny Bowling hosts this show, Pivot to Prosperity, where she interviews people that can do just that. Play on workdays. Many guests have become financially free. She also interviews people that are on their journey and people that are in support roles, like attorneys, contractors, brokers, and others. Commercial real estate is the common element. She is on a mission to be sure busy professionals know they can own substantial commercial properties too, like apartments, self-storage facilities, and others, and not have to do the work managing them. Passive investing is the key. Syndications are the typical method. Tax write-offs are some of the biggest rewards. Ginny and partners find the deals, build a strong team and business plan, then offer the investment opportunities to passive investors. New episodes are released every Tuesday at 12, so watch for new releases. If you want to get involved, let us know. You need to get pre-qualified to hear about most deals. See the show notes for contact information.
Hello, Ginny Bowling here with Pivot to Prosperity, brought to you by Pivotal Real Estate Investments, where we help our investors build wealth and income through commercial real estate that improves communities. And today we have Danny Flores with us. And Danny, thank you for coming. Appreciate it.
Thank you, Ginny. Thank you for having me. It's a pleasure.
I goofed. I didn't ask you if you had a bio. Usually I like to read a bio for people, but why don't you go ahead and do your spiel on your background and all, I guess.
Well, okay, so I'll run through it fast and then you can come back and ask me any questions that you may have.
Okay.
So my early part of my career, I was in construction. I was in the building industry for 16 years. Then I decided to pivot, go back to school. By then I knew I liked numbers. So I went back to school, got a finance degree, and I went into banking once I graduated, became a banker. We did 25 million to over $1 billion loans. We syndicated those from bank to bank. But my passion and my dream was always to buy a multifamily. So I started saving money and bought my first fourplex in California, Norwalk, California. In about a year and a half after that, and that was in 2000, about a year and a half after that, I sold it for about $100,000 profit. We did an exchange, bigger building, saved some more money, bought another one, and did that for about 15 years. Also, during that time in 2006, I started a property management company, LA County, Orange County area here in California, and grew that business. Sold it about 4 years ago. In about 2018, a friend of mine said, "Why don't you syndicate?" He saw what I was doing in the apartment industry. And I was like, "What does that mean?" I kind of didn't know. And he says, "Well, my mom and dad had invested with a syndicator in the projects that he was doing in LA. They made plenty of money. He put him and his sister through college. They bought a few houses out in West LA." And I was like, okay, that seems to work. I need to figure this out. I need to learn. And long story short, 2018, I learned how to hire a coach, learned how to start raising money to do larger projects. And that's what we've been doing with a little bit of my background in construction, my finance, my property management background. It's given me a good skill set to be able to manage our projects and make them successful.
So that's a terrific background. So I've got several questions. First of all, though, you did say that you were syndicating bank to bank.
Yes.
So what were you syndicating?
So what happens is, because these loans are so large, if somebody comes, and these are companies like Jack in the Box, Metro Golden Mayer, Smart and Final, their loans, they could be $1 billion,
Syndicating
500 million, 400 million. And not one bank holds that paper because of the risk. So they mitigate the risk. So it happened to be either we were the lead bank and we led the deal because it was one of our clients, and we brought other banks into the deal, bringing in maybe 5, 10, $20 million a piece. So we got a group of banks to hold the paper. Or sometimes we were invited to participate in another bank's deal, and we were putting in 5, 10, $20 million at a time. And it's just strictly within the banking from one bank to another. And that's how they mitigate the risk in case of the deal goes sideways.
So did you have to do any of the presentations to the other banks, or was there even a need for a presentation, or did you just, what'd you do? Just send a data sheet, or how did that?
No, it was actually when a deal came. So basically how the banking structure is that you have relationship managers throughout the bank that deal with the clients, and they have a limit on loans up to a certain amount.
Yeah.
And when these companies grow or a new client comes in that has a larger need, they would come to us. So we were one unit in the bank that all larger deals were done through us. And so in regards to presentation, we get the deal. We had to do a lot of underwriting, a lot of analysis, a lot of modeling of, growth, their current same store growth, or whatever the industry was. There were different industries that came to us. And so we had to learn about the industry. We had to learn about their market share within that industry. We needed to understand how good their operations were. So we had to have like manager analysis and find out what the management was like, how they compared to their peers, how their growth compared to their peers. And then we had to also figure out what were worst case scenarios as well. Primary forms of repayment, second forms of repayment. And so when we're done putting all of this together, it wasn't just one sheet, right? It's too much information. There were actually books. And we needed to get approval from the credit department within our bank. So just because we liked the deal and we thought the deal was good, we couldn't just do the deal. So the banking system has checks and balances. And so we had to present to our whether we're participating or whether we were leading, we have to get credit approval. And if we get that blessing, and that's the same pitch book that we would pass around to the other banks. So it's kind of crazy because as we're coming down and, you have deadlines, and you know how it is, everything kind of happens in the last minute. You have the copy service standing next to us, so we can give them the file. They will run to their shop, print these books, bind them, and getting ready to pass them around. Yeah, it was cool. It was like,
That's a great way to cut your teeth. Yes.
right,
Oh,
right.
God.
So that was right after school. So everything we've learned in school, finance wise, now we're putting it into practice. Like we're spreading these financial statements. We're building these models, and this is before I even touched multifamily.
Oh yeah, yeah. This is
Right.
good.
And there are complex models that we're building, and everything has to tie to each other. So you learn finance and accounting really good. It was great
I
experience.
gotta look at one of your deals now.
Right. And then the other part is you get the approval. Now you're dealing with the attorneys and putting the docs together. So it was for sure a great experience
Yeah, for sure.
to have
Yeah.
that opportunity.
I figured as much. Well, so and then you said you were in construction. And so we were talking a little before we started recording, and
Mhm.
that's where you excel, I guess, right? That's your
Right. Yeah. So I knew it early on. I was lucky enough to know early on that I was good with my hands before I found out I was good with numbers. And I wanted to be a builder. So I learned how to build. I became a general contractor when I was 21 and was in the residential business, building homes and room additions and remodels, which gave me a good skill set for what we do today. And well, what happened was I switched in between there from residential to heavy construction. And that means building bridges, underground tunnels, waterways, vertical wall channels with big,
What
heavy
made you do
equipment.
that? That's unbelievable.
That was cool. Because in the late 80s, early 90s, the aerospace industry left California. And that was my first punch in my nose of a recession. Like, hey, I mean, I had no idea what a recession was. I was like 23 years old at the time, but I remember it. And so I still was full of energy, and I didn't want to sit in a desk. And I had considered maybe civil engineering, going back to school for that, but there was like, no, I don't want to do that. Not yet. I wasn't ready. I don't think I was ready to do that. And so I stayed in, I shifted to heavy construction. I became a union carpenter, and I swung a hammer for 11 years and had a good time doing it. And that was before I went back to school.
And when you went back to school, is that when you got the finance degree?
Yes. So
Okay.
I was lucky enough to get accepted to go to USC. At the time, I worked a lot of overtime. My average work week was about 75 hours in the building industry. So I actually cut my work time from 75 to about 55 hours and went to school full time. Took me about 6 years to do that. Probably the hardest thing I've ever done. I don't think I can do it again, and I don't wish it upon anybody, but I had to pay for school. SC wasn't cheap. And I had to study and I had to work. So I figured it out. I had to study standing up and make it happen. I mean, it's when you have a goal. It was my only way out that I saw out of construction, and I wanted to be a banker. So I had a specific goal that I was going to attempt to accomplish. And that's the way I did it. And I do have to say, I have one of my boys, I have 4 boys. One of my boys is actually starting at SC next week. So I'm pretty proud, pretty happy, keeping it in the family.
And a moment ago, did you say you wanted to be the bank?
No, not the bank.
Like, oh, okay.
Yeah.
Okay. Yeah, that's, yeah. And 4 boys in college. That's really tough to do.
That's
usually.
heavy duty, yeah, for sure.
Yeah.
But you know what? I love it because all 4 of them are going, right? As a father, that's like one of my biggest, well, it was not a worry, but it's like, hey, I want all my boys to get educated. I want all my boys to reach the limits that they want, not my limits, but their limits. And I wanted them to go to college, and they're doing it. I have two that'll be finished. They're on their last year. They'll be done next year. And then I'll just have 2 left.
We just talked about terminology a minute ago. Don't call it a limit.
Yeah, right. Unlimited.
Yeah. Anyway, so then also you were saying, well, so, okay, so let's go to when you buy a multifamily property, you're usually buying value add. I think you had mentioned.
Yes,
well,
that's what we like.
reporting.
Yes.
So talk about what you do, especially since you excel at the actual turnover, to get the transition into your management. Well, or do you keep theirs, especially since you sold your management company? Do you use that company now?
No. So the sale of my company is strictly for smaller deals, single family homes. So that's, 10 units, 15, 20 units. So the gentleman that bought it, he operates in California. So it's not intermingled. We actually hire property management companies, third-party property management companies, and they do the management for us. We run tight budgets with them, and kind of we watch. I mean, we manage pretty close, pretty tight to be able to get the results that we want.
So when you hire a management company, you must tell them that you're going to be probably intimately involved in, or do you handle all of the new, the renovations and all of
Yes,
that?
yes.
They're not even involved, or they're involved in cleanup, or?
Oh, no. They're intimately involved under our direction. So when we do the acquisition, we kind of already know our CapEx plan prior to closing on the deal.
Sure.
While we're in escrow, we're talking to, we hire contractors that do our build outs. So during escrow, we're going through that budget, and we're getting our contracts written up by the attorneys. And we actually are preparing to get the contractors to the starting line, which is technically our finish line on the acquisition side. At the same time, the management company is intimately involved because the management company manages the tenants during the whole renovation process. So the management company, and actually us, right? We have weekly meetings or even bi-weekly meetings, whatever we have to do to address issues that come up. and to make sure that our business plan is getting executed. And so the management company will manage how we shift the tenants around to create batches, because we force these batches for our contractors to do. So we'll figure out how fast and the tempo, what that looks like with the contractors, whether they can do, like in the last one, we initially started doing 12 units per batch every 4 weeks. But what was happening is that our leasing team was on fire and had all the units pre-leased prior to the contractor finishing. So that sent me a flag up and says, hey, wait a minute, we're going too slow. We got to capture this wave of leases. And so I talked to the contractor and it says, can we go from 12 units every 4 weeks to 16 units every 4 weeks? He goes, no. He goes, I can give you 16 units every 5 weeks. And I'm like, okay, we'll take it. Because that speeds up the whole tempo on the back end. And
Right.
so they were able to ramp up 16 units a batch every 5 weeks. We make a schedule all the way to the end, and they have to deliver on the date they promised by every 5 weeks. And what was happening is we had such a phenomenal leasing team that we were able to lease, basically have the tenants moving in the day that the contractor gave us those batches. So we had the cleaning people right behind in the morning. We had tenants moving in, and we kind of figure Fridays are the best days to get the batches to us, because then the tenants have the weekend to move. So we kind of have a system, like it's a slick system. It's very efficient and it produces great results. And in that case, on that community, we actually were able to keep about 83% of the tenant base. So the tenants were happy where they were at. They liked their neighbors, and we had great customer service, because we interviewed our staff and asked them, like, what's the key to being able to accomplish this and to keep 83% of the tenants? That means we didn't have to go out and find new tenants and maintain. So we maintained high occupancy during the renovation. And they said it's customer service. Take care of your tenants. They're your customers. They're your people. Treat them right. Follow up with them. Make accommodations for them. And, that speaks volumes for itself. I mean, we have great teams out there, and they do this for us. We have great contractors that can stay on schedule, and them on the back end, they're managing their supplies. They have these huge warehouses where they buy supplies way ahead of time, so that they're never running out of cabinets or light fixtures or plumbing fixtures. And they basically got it dialed down. They work real well together, and we're real happy with what we've been able to do. And this is, at the end of the day, this is what we do for our investors, right? Because the investors are the ones who are able to reap the rewards of running such a tight ship on their projects.
Right, for sure. Well, so, and is this class A, B, C? What are you buying usually?
We usually buy BC, hopefully C's, high C's in B areas, so we can convert them to B's.
Okay, so
Workforce housing, basically. Now, and so this was what we did, but we all know the economy shifted a little bit. We know that interest rates went way up, so that the model changes a little bit from just doing heavy value add to, we've bought some buildings that were already renovated that was strictly operational plays, meaning that they're not running efficient. They've spent the money to renovate, but they don't have the right team in place. They're not pushing them the right way. They don't have the right business plan in place. And all the deals that we buy are all off market. So we have that advantage where we don't have a lot of bidding and it gets too crazy. And so we find these buildings, and we've gone in there because the mindset of the investors has shifted a little bit from liking these heavy value add deals, kind of not receiving any distributions for a year or 2 years till the buildings get stabilized. And then if they get sold, you get your big bang at the back end. So now we have competition. We have treasuries paying 5-6%. they're safe. So investors are looking more for that mailbox check coming in, right? They want distributions during the whole period. So we have to shift a little bit. We have to listen to what the investors want, and being able to shift on the type of deals that we buy, that they cash flow sooner rather than later. The other thing is that bridge financing is very expensive. So when you go out to try to get a bridge, you got rate caps you have to buy, rate caps that costed $100,000 back 2-3 years ago will cost you over $1 million now. That adds up to the cost of the project, and that takes money away from the profits and less to the investors. So we shifted a little bit and trying to find different projects. We want projects that cash flow probably within the first 6 months, so they stabilize quicker for our investors, and just give them what they want. Basically, I mean, without them, we don't exist, and we actually work for them and give them the ability to have a place to go where they can actually park their money and probably get better returns than some other regular investments, such as the stock market and such.
So, and there's differing opinions on floating rate today. As you've said, it's very expensive. Are you
Yes.
doing any floating rate at all right now, or no?
We've been lucky enough to have probably 95% of our loans are either have been loan assumptions, have been owner financing, or have been fixed rate loans. We do have one that we do have a rate cap, and we're in the process of doing an extension on it. We're super happy that rates are coming down, because doing the extension, we'll have to buy another rate cap. And these are 1-year extensions on them. So we're safe. We have great debt coverage on that. So we're safe with that. But nevertheless, we have to go out and buy another rate cap as these rates are coming down. I mean, the price of the rate caps are coming down by the 100,000s at a time.
Oh, that's good.
So let's see. I mean, we're expecting, maybe one or two in September, and everybody's pricing that in. And we can see that by what's happening with the treasuries. And we have our fingers crossed that they continue to come down. I mean, timing might be perfect. Let's see.
Yeah, it's sounding pretty optimistic there. And so as far as the strategy that you're using, for instance, as you were discussing it, it occurred to me, besides, of course, listening to your investors, which you need to do, is keeping, I guess every market's different. Of course, you have to look at how much of a rent bump you can get if you go ahead, and if you're going C to B, you're not necessarily doing quartz or granite or something like that, right? Are you staying away from that and just keeping it so it's modest and stays workforce, so that you can keep that tenant base? Is that kind of the goal, to keep the tenant base and make the materials fit the?
Yes, that's a great question, because you have to understand who your tenant base is and what their price point is. So if you spend too much money on the unit, you're not going to get the return for it. So yes, we usually don't do quartz. We usually do, for countertops, we usually do PLAM, which is kind of an image of quartz. So they look fancy, but it's still, they probably cost us, let's say, maybe about $300 to $400 to use those countertops, versus stone would be about $1,700. So yes, and it adds up, because you got to remember, it's times how many units there are. So it's not just $1,000 one time. It's $1,000 times 100 times 200 times, and every expense that goes up, it's times that. And so you have to watch your budget. So when we go in, we know what our budget looks like, pretty much what we're going to do. Depending on how intrusive the renovation is, we add a contingency, right? Because the more intrusive it is, the bigger the contingency, the bigger the unknowns. If you start opening walls, you might have to relocate receptacles, you might have to relocate plumbing. But if you're not being as intrusive, and let's say your new cabinets are falling within the same pattern as the old ones, then you can include a little bit less, but the whole idea is to stay within the time budget, because time is money. You have carrying cost, which is the interest you pay on the money that you're using for the CapEx, and you have the downtime cost. So that means the downtime from those units being vacant. There's a daily cost for that. So you have to watch that and mitigate it very tightly. And then the other half of it is your overrun on your expenditures for your CapEx. You got to run a real tight budget to make sure that you don't end up going over that and that you're well capitalized as well, just in case. So you have to include that. And so it's not just about adding things and whatnot. You have to know it really well. Like, we already know the doorknobs we're using, all the hardware we're using, the faucets, the light switches that we're switching, the receptacles, and we have sheets where we have everything dialed in. Our contractor is really good about putting that together for us. And we have everything marked, counted, tallied for the square footage for carpet, the type of floor you're going to use. And yeah, it works out pretty good. You've done it. If you do it more than, if you've done it a few times, it gets easier. I'm not saying it's easy, so I don't want to mislead anybody, but it gets easier.
So now, and I know you have had a lot of units in California. Now, when you speak, where are you picturing when you're talking like this?
We're very active in Arizona. We love the Arizona market. We know that, people say there's a lot of competition there, but if you understand the Arizona market, Arizona has about 5,500 people a month moving in. You have a lot of businesses moving in. And if you get to know the area, you can see what the state is doing as far as their infrastructure, their roads, their overpasses, their underpasses, that they're building out. And there's so many new buildings out there. You have data centers going in, you have high rises going in. Yes, there's a lot of
5,500 a month, is it?
Isn't that crazy? That's a lot of people consistently moving in.
That's
And
the whole state though, right? Yeah.
yes, that's the whole state, not specific to Phoenix or Tucson or some of the smaller cities. But nevertheless, the bigger city, which is Phoenix, is going to get the brunt of that. And then we also know that because of the increasing in interest rates, that the new builds slow down. So in 2026, we're tracking, and we know in 2026, there's going to be about an 80% drop of new product coming online. And when
Substantial.
that product the absorption gets completed, which should be fairly quick if the growth rate continues and the businesses moving in continue, then that's when we're going to see occupancy starts, hitting the ceiling near 100% occupancy, and you're going to start seeing rents climbing again. And when that happens, you're going to start seeing valuations coming up again. And then the other half of it is, if we see interest rates dropping, which if they start now and they continue to drop, I think the competition is going to be fierce again.
Yeah.
And that's not maybe just in Arizona, in other states as well. We're in other states too. So I think that's going to happen in potentially a lot of the metros, because it's kind of the same scenario, right? You got Texas, you got Florida, where you have a lot of industry moving in, a lot of businesses moving in. California, nobody wants to be in California anymore. You got everybody moving out, right? We're doing a good job to keep it not too business friendly.
Do you have anything in Florida at this point?
I just partnerships on other deals that we don't manage. So
Gotcha.
we just kind of invested in other deals that way, but nothing directly. And Florida is hard, and I know you're in Florida, but you got the hurricanes and you got the insurance issues. It's and then we're on the West Coast, so it's like there's plenty of stuff out in the western states that keep us busy, so we kind of don't have to go out there. It's a great
Right.
place to visit, don't get me wrong.
Likewise.
Right?
The two far ends, yes.
Yeah.
That's so true. Well, and we probably ought to ask you that big question here now. We're starting to get long-winded maybe, but I ask everybody at the end of the interviews if there's a pivotal person or event that has either brought them to where they are or pushing them forward to some particular goal. And what would you?
I think there's more than one in my case. Kind of going back when I did my career change, going back to school kind of gave me learning how to model all these different ideas that I had that I would actually put on paper. I had no idea how to use Excel at the time, but as I learned how to model, I was able to translate my vision on Excel and say, okay, I saw a lot of things. So that's kind of one eye opener and how I was able to piece it together. Then moving along, when I made my transition from kind of my own investments into multifamily syndications. When I did that, I actually hired a coach, Lisa Parrish, and she was my coach for a year. And I kind of learned the syndication side of it and kind of how to operate bigger buildings. I mean, I came to the table with a lot of skills, but I just needed to learn a handful more, which made it even easier. So she helped me with that. And then I have another friend that I met over 20 years ago in the business. Early on in the business, we've stayed friends. He's a very successful apartment acquisitions guy. And you know, when I need to go in and be super competitive on deals, buy deals cash, I can bring him in and we can close deals super fast. So his name's Dan Wayne, and he's a friend, and he's been able to help me. So I have people, that have been there and that have helped me, and I do have like a group of people that I can call and just stay in touch with, right? It's your network that helps you, and then at the same time, I'm here to help whoever needs help as well. So be able to give back that way and just kind of, sometimes help people, give them direction sometimes, or just my own opinion.
Right. It is a team sport.
Oh, absolutely. Absolutely.
Yeah.
It's a small world.
Yeah.
Just be nice to everybody and help everybody, and you'll be okay.
Right. Yeah, that's definitely what I subscribe to.
Mhm.
So, and I should tell you, we do something special if you want to actually nominate either of them as a pivotal person.
Okay.
You could call them and say you nominated them, and then I'll call them, or I could call and say that you nominated them, and then they come on the show if they want. And they
Okay.
get a special banner and special things, and then I send them a pin that says they're a
Cool.
pivotal person that they can wear,
There you go. There you go. Okay.
Yeah, you want to nominate them or one of them?
Yeah, I'll see who's available, and then I can reach out to you after the show and
Sure.
and nominate somebody. See if
Okay.
they want to get on.
Yeah.
Some do and some don't, right?
Right.
Some people are gun shy and some of them are not. So whatever I can do, absolutely, I'm here to help.
Okay. Well, great. Well, so now I think that you've been a lot of information that's a little different because you're a little more construction oriented than a lot of the guests I've had so far
Mhm.
too. So we talked before the show that you might have something you can share with people about that construction side of things. By the time this airs,
Mhm.
we might have something special in the show notes, depending on
A
what
special
Danny can work
surprise.
up here,
Yeah.
right? Do some
Get
magic.
everybody excited, right?
Yeah. Pressure's on.
Yeah,
Okay.
yeah.
But tell people how they can reach you. We'll put it in the show notes too, but go ahead and tell people.
Yes. You guys, if somebody wants to reach me, you can go through our website, www.primecapi.com. We have contact information, fill your information in, and we'll be standing by and be happy to reach out to you. And we'll add some other stuff in, email and phone number as well.
Right. Yeah, for sure. Very
Mhm.
good. Well, thank you for coming on the show. I appreciate it.
Thanks so much, Ginny. Thanks so much for having me. Always a pleasure.